that in spite of official gold market interventions against the dollar, gold would have to be revalued literally hundreds of dollars higher. And now it's inevitable that by the fourth quarter of 2024, spot gold will be over $2,500. And most of the same liquidity providers that predicted over 2,000 spot for the end of 2023 are now gravitating closer to $3,000 per ounce. It's not that the dollar gold price is actually rising at all. It's actually that the purchasing power of the bankrupt, debt-laden dollar and all the related fiat currencies is en route to slipping to zero against gold.
The end of 2023 and the start of 2024 present an environment that is broadly supportive of gold prices. Interest rates are expected to be cut back aggressively. As such, the US dollar and Treasury bond yields have been in broad decline. Since gold is a non-interest-bearing asset, it can become more appealing when interest rates fall as the opportunity cost of holding the precious metal declines. AndrewMaguire, independent London metals trader, states that gold initially resisted but closed 2024 firmly at $2,784, $254 higher than its 2023 opening level. Meanwhile, central banks, sovereigns and institutions embraced gold as a rival to US Treasuries. In a world where economic chess is the game, central banks have made a power play, amassing a record-breaking 374.1 tons of gold in 2023. This isn't just any gold rush. It's a strategic maneuver to fortify the US dollar amidst the growing influence of the BRICS alliance and their de-dollarization plans. However, Maguire asserts that central banks are preparing for a gold revaluation, foreseeing gold prices exceeding $2,500 by the fourth quarter. Maguire explores bullish drivers for gold in 2024, such as Russian-chaired BRICS developments and global de-dollarization. A gold-backed currency is expected to drive gold values well beyond $3,000. In this high-stakes game, Russia and China are leading the charge, with Russia integrating gold into its fiscal fortress policy. It's not just about weathering sanctions, it's about crafting an economic bastion where gold is king. The diversification drive is like a financial ballet, with countries pirouetting away from dollar dependency towards a more multidimensional economic stage. Moreover, in 2024, Basel III NSFR compliance takes center stage, serving as the foundation for spot gold markets with a tenfold increase in scale. We will present clips from AndrewMaguire's interview with Kinesis Money. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
With spot gold opening up at, actually it was 1824 was the, of course these things are burned in your mind because as we move into a new year, you want to see where we're opening and really what we're projecting to be where we would be going. And we're looking at that again for 2024. But on the it was at 1824 on the first trading day of 2023. Now, Basel III NSFR compliance became mandatory on that very same date. Now, this meant that for the first time in history, the liquidity providers operating in the global foreign exchange markets were forced to back their spot gold offerings one-to-one backed by physical gold. Now, huge difference. The deliberately unreported 2023 physical gold compliance changed the gold price suppression game as gold began to be sought by central banks, sovereigns, and institutional traders seeking an alternative first-tier asset class that directly competes with US Treasuries. Now, despite a year of official pushbacks, right on cue, just as we expected, gold finished strongly above $2,000, fixing at spot $2,078.40. Now, that was $254 over than the 2023 open. Now in 2024, and this is the reason we're going through this, well established. I mean, Basel III NSFR compliance is now locked in and fully complied. And it's underpinning this 10 times larger the spot gold markets. And gold, having been reclassified as real money, that the real money it is, provides every other global central bank and sovereign entity a perfect, live, tradable foreign exchange de-dollarization instrument. Now, this is going to be the story of 2024. And let's kind of look why. Every global South central bank, bar none, as well as European and Asian central banks, are positioning to revalue gold. We'll look closer at the process as the weeks play out. But one thing is clear, as it was at the commencement of 2023, really. In fact, one of my most respected liquidity providers, very closely associated to the Russian-Chinese markets, sees the Russian-driven BRICS chairmanship driving Glazyev's gold-backed commodity currency forward. And given that, and people are not expecting this, it's been poo-pooed by a lot of people. This currency, as it gets brought forward, they're estimating that $3,000 is the bottom of the range assessment. It's not that the dollar gold price is actually rising at all. It's actually that the purchasing power of the bankrupt, debt-laden dollar and all the related fiat currencies is en route to slipping to zero against gold. There'll come a point where no amount of dollars will actually buy an ounce of gold.
Silver is trading below the 200-day simple moving average, SMA, and recent price action has formed a bearish pennant-like formation. The daily close today could provide significant insights as it may indicate a breakdown of the pennant pattern, typically suggesting a continuation of a bearish trend. Andrew sees that insiders in the silver market have successfully manipulated conditions to set up a bear trap, leading commodity trading advisors, CTAs, to adopt a bearish stance. This manipulation resulted in a bearish monthly close at the end of 2023. Despite CTAs falling into this bear trap and selling into the declining trend, Andrew highlighted that today's daily close could provide crucial information. In Andrew's analysis, the worst-case scenario for March silver would involve a gap close, testing the low from December 13th. Although there was a close call to testing this low, he noted that long positions were liquidated mainly during the gap close. The failure of silver to establish a new low, especially after a non-farm payroll news event, is seen as a signal that long positions have been cleared, leaving short positions exposed. As the selling momentum diminishes, Andrew anticipates a robust short squeeze rally to unfold, primarily driven by commercial actors. Let's get back to the interview.
Unlike gold, insiders managed to trick the CTA's bears into close silver low to successfully chart paint a bearish monthly end-of-year close in 2023. As a result, CTAs once again got sucked into this bear trap, which they are in now. However, given the paper-centric action rails against the largest Indian and Chinese silver buying in 2023 and follow-through buying in 2024, the commercials have actively been setting up this bear trap, tricking these derivative traders into follow-through selling into news events such as non-farm payrolls, and just as physical demand picks up in 2024. The option structure actually reflects this bear trap, as once again, it's the same way as it was in October, November, December. The CTA spec group controlling close to 80% of the open interest, who've bet against the market-making insiders who are tricking them lower by strategically pulling bids, not going short, just pulling bids at the correct places at the pivot points. They've taken the long side of these option bets against them. And guess who's going to win this bet yet again? And we figured the worst case for March silver, which is the front contract for silver that is measured on the futures exchange, which is where most of the open interest is, that would probably be, the worst case would probably be a gap close, which would have seen the 13th of December 22,795 low being tested. And they came close to testing that so far. But that kind of a gap close would put the commercials back in the same bullish long structure against the speculators that had subsequently triggered a whole $1.30, that is $6,500 per contract, short squeeze, rinse into the 24s on the 13th of December. If you remember, we saw that spike higher. And once it starts to move, then obviously they need to ring that register quickly. Now, drilling down, what caught my attention was that longs were all washed out into this close to gap close. And it was the failure for silver to make a new low despite a non-farm payrolls news beat. It had made the low before that, day before that, and the non-farm payrolls news beat normally would have hunted out the prior low, and it didn't. It kind of illustrates the longs are all out and the shorts are getting extremely rinsable. And once this momentum selling peters out, then we'll see a strong, commercially driven short squeeze rally commence.
In a world where economic power is increasingly multipolar, gold emerges as a universally accepted symbol of stability and value. The central banks say, "We may not know what the future holds, but we'll have our gold just in case." How will gold continue to position itself following the evolving global trends? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.